This is a pig named Pip. Pip is great at baking. Pip opens a bakery. No other pigs want to pitch in their carrots. Pip buys his own flour and sells his own pies. If the bakery makes a profit, Pip keeps it all. If it loses money, Pip takes the hit. In America, they call this a sole proprietorship. Doing everything alone wears Pip out, and he runs out of carrots. Pip asks his buddy Pop to pitch in some carrots. Pip bakes, Pop delivers. Both names are on the shop. This is called a general partnership. Both pigs face unlimited liability. If a customer gets sick from a pie and sues, both Pip and Pop must pull carrots straight out of their personal pockets to pay. Terrified of losing their personal savings, the two pigs switch to an LLC. Now, each pig is only liable up to the exact amount of carrots they invested.
Another customer gets sick and sues. The LLC pays with the company's carrots, but Pip and Pop's personal carrots are perfectly safe. Pip upgrades the recipe. The pies taste amazing, and no one gets sick anymore. Business is booming. Pip wants to franchise across the US to get more carrots, but he's broke. So Pip splits the bakery into millions of tiny pieces. He tells the other pigs, "Give me your carrots, and I'll give you a piece of the bakery." This is called a corporation. To prove the other pigs own a piece, Pip prints out official papers. Those papers are called stocks. The pigs who chip in carrots get stocks and become shareholders. They get to attend meetings, vote for the CEO, and get paid dividends if the bakery makes money. If the stock price goes up, they can sell for a profit. If it drops, they lose.
Pip controls the bakery because he owns the shares. But some pigs don't care about ownership. They just want a safe bet by lending their carrots back. This pig lends carrots to the bakery and gets a piece of paper in return. This paper certifies that the bakery borrowed his carrots and must pay them back with fixed interest over time. That's called a bond. Bondholders don't get to vote or split profits, but they get first dibs on getting their carrots back if the bakery goes belly up. Lower risk, lower reward. Another pig doesn't want to pick stocks or bonds himself. He puts his carrots into a fund managed by the pros. This fund pools carrots from thousands of pigs to invest for them, giving him a paper called a mutual fund share. If the pros make a profit, the pig makes a profit. He sleeps easy, but he gets zero say in which bakery the fund actually invests in. But some pigs love taking control and crave adrenaline. They like guessing whether the bakery's stock will shoot up or tank, and they place bets with other pigs. They don't actually own a single real share of the bakery. They're just playing a price-guessing game tied to a contract. Wall Street calls this derivatives. Then there's a pig who gets a special paper as a reward. This paper gives him the right to buy the bakery's stock at a super cheap price. He can use it or sell it to another pig, but the paper has an expiration date. That's called a stock warrant. If the pig acts fast while the market is hot, he hits the jackpot. If he waits too long, the paper becomes worthless trash. All those powerful papers are collectively called securities. A pig wants to cash out his securities for carrots. He takes them to a regular supermarket, but nobody buys them. So he takes them to a massive stock supermarket where other pigs are eager to buy. To get a piece of the bakery, pigs don't buy directly from Pip. They buy from other pigs here. That place is the stock exchange. One pig is super sharp. He reads financial news daily, watches Bloomberg, and checks out the bakeries to know exactly when to buy and when to sell. He's got real knowledge. Then there's the clueless retail pig, jumping on Reddit or TikTok hype, buying total meme stocks. But the funny thing on Wall Street is, both pigs can lose their carrots because nobody can beat the market. To guess the price, pigs learn to read charts. They see dancing green and red bars. Those are called candlesticks. A candlestick has two parts. The body shows the opening price at the start and the closing price at the end of the trading day. The wick shows the highest and lowest prices of the day. A green body means the price went up. A red body means it dropped. Pigs look at these candles to decide whether to buy, sell, or just sit tight. Drawing lines to connect the candles and see trends is called technical analysis. Pigs also use the RSI indicator from 0 to 100. An RSI over 70 means the forest is overbought and the price is hyped. An RSI below 30 means the forest is panic selling or oversold. A smart pig won't buy when it's overbought at the top. He waits for the panic at the bottom to scoop up the carrots. Pigs also use the MACD lines, one fast, one slow, to catch the trend, and Bollinger Bands as price boundaries. If the price hits the upper band, it might drop. If it hits the lower band, it might bounce. Those are resistance and support zones. Unlike the technical traders, there's a white pig who never looks at candle charts. This white pig goes straight to the bakery to check out the real business. He digs into quarterly revenue, checks if the shop is packed, and looks at how many carrots they owe the bank. He judges if the baking industry is growing and if Pip's shop has a moat, like a secret recipe or master chef's. Wall Street calls this fundamental analysis. Fundamental pigs don't buy stocks because the price is flashing. They buy because the bakery is solid and pumps out carrots consistently. When bakeries thrive and the whole economy booms, stock prices skyrocket and everyone wins. New pigs see the easy money and flood into the market. They call this a bull market, like a giant bull charging and tossing the market up. During a bull market, you can buy blindfolded and still make a profit.
But the party doesn't last. Prices start to reverse and crash. Pigs panic and sell off. New pigs stay away, and old pigs are too scared to buy. The charts turn into a bloodbath. This is a bear market, like a massive bear swiping and crushing the prices down. Long-term investors suffer, and day traders get wiped out of their carrots completely. Seeing the market hit bottom and show signs of recovery, a day trader bets on the upside, hoping to buy low and sell high. That's called going long. But if he guesses wrong and it keeps dropping, he takes a heavy loss. On the flip side, when the market crashes, a pig borrows stocks from another pig to sell them instantly at a high price, waiting to buy them back cheap later to return them. That's called short selling.
When buying stocks, every pig wants high liquidity, meaning it's super easy to turn that stock back into carrots. If other pigs buy your shares instantly, that's high liquidity. If you shout till you're hoarse and nobody cares, that's low liquidity. Stay long enough, and a pig becomes a market veteran. But the brand new pigs, who don't know candles or what the bakery even sells, are called retail investors, or Wall Street's favorite targets. These pigs easily catch FOMO and buy the exact top, end up bag-holding heavy losses, and get liquidated by listening to internet scams. But every pig has to start as a rookie to become a pro. Stay sharp and invest smart. Pip is sleepy now. Time for bed. Goodbye.